Yeah, it was. We're seeing that the dollar is like, in this wrecking ball. You have the old demolition crews. We have this wrecking ball just goes through a building. This is what the dollar is right now, thanks to Mr. Powell.
British pound crash can mean for your client's portfolio.
And not because of the trade with Europe. I mean, the trade with Europe is not insignificant. You showed me that chart. Maybe you can just think of like what would happen if Deutsche Bank imploded. You would have carnage all across U.S. financial system because there's so many connections.
All right. Hi, everyone. Welcome to episode 10 of Investing Counterpoint. A lot of people make big deals about their 100th episode when they reach triple digits, but for us doing 10, we're getting there. So we're on a roll here, Daniel.
That's right. And we're not going to stop. And it's actually very easy to talk about the markets now. You just have to choose. Like, you used to have to think about what are you going to talk about today. Now it's like, what are you not going to talk about? What can you omit? Because we don't want to make it too long. Remember, this is a show for financial advisors and other financial professionals. If you're not and you like it, fine, you can stay. But don't forget to subscribe. I keep forgetting that. This is the 10th episode, and first time I said that. Don't forget to subscribe to the channel because we're going to be doing this weekly. If you like what we do, please invite your friends, even if they're not financial professionals. I think you will see a different look at the type of events we are seeing in the world, and it's not going to be boring, Jan.
Well, I hope not. Otherwise, nobody's going to subscribe. So let's try to make it boring. So today, Daniel, we're talking currency, which isn't normally the most exciting of topics, but we've seen a lot of strength in the dollar. And so, let's dig right in here.
Yeah, it's like there's an old Chinese curse, may you live in interesting times.
Yeah.
We're all experiencing it. We're seeing that the dollar is like, in this wrecking ball. You have the old demolition crews. We have this wrecking ball just goes through a building. This is what the dollar is right now, thanks to Mr. Powell and the crew. So it's wrecking economies, it's wrecking companies. Because think about it, if you owe anything in US dollars and there's much debt in US dollars, then right now the economy is in a slump. I mean, everybody knows the world economy is experiencing really tough times. And at the same time that you're having a hard time in your business, now your debt is just increasing in value because the dollar just keeps going up. I mean, we see that the pound is down severely against the dollar. We see that euro is down in a big way. We see Japan to some degree. We'll talk about Japan later, but I think that to me, the two biggest topics right now is the pound and Europe in general. The pound, I was surprised to see it that weak, but I guess it's because of the new government they creating lots of stimulus packages, trying to keep the citizens warm in the winter, creating energy stimulus packages and various fiscal incentives. But I don't know what's going to happen in Europe. It seems like Europe is imploding. And just today we heard the news that apparently there's an explosion in the Nord Stream pipeline, which was one of the remaining pipelines that feeds gas to Europe. I heard the news that BASF, which is the main industrial giant in Europe, is considering shutting down some of its plants. I mean, for Europe, think of like Ford closing its factories in the US, but it doesn't even describe. It's like, take the whole, Ford and all the other companies together, right? All the other auto companies together closing. And even that wouldn't describe how serious this is. Europe is on the verge of implosion. It doesn't have energy. It does not have a lot of its own energy. It does have some, like Romania has some gas. I think they're exploring some.
Norway and the North Sea of the UK, they have a little bit, but it's not enough. It's not going to be enough.
That's right. And there's some gas of the Sea of Cyprus, but that gas, there's a dispute as to who owns it. So if there's any development there, it's probably going to be another war.
Right.
So yeah, the Europe is clearly imploding economically. It's a very, very tough situation. But for us, we have to understand, how is it going to how's that going to impact the portfolios, right, Jan, right? Europe, pound, and now, I'll bring in Japan a little bit, because Japan is a fascinating situation for me. They still haven't raised rates to any meaningful degree, yet the currency is holding up somewhat. And we're going to try to, think for your portfolio today, what does Europe mean? What does British pound mean? And you can, John, what does Japan mean, Jan? What do you think?
Well, I think that's right. But let's take a quick look at some charts here, Daniel, before we jump into this, because I think it's always good to kind of understand where we are. And we talked about this a little bit earlier. This is a dollar basket. So this is a dollar, the US dollar against a basket of other currencies. And this goes back to about 1965 to the present. And what we see is where this is quarterly, so it's not a daily spike or daily chart or anything like that. But what we can see is this is certainly unusual since the 2005 getting up to this level. But it's not unusual historically. But like you pointed out, Daniel, there's a lot more U.S. denominated debt relative to the size of our economy. So this has the potential to be a lot more painful for other countries. And there's a couple other interesting differences here with this spike. I mean, where is it coming from? The pound, as you talked about, collapsing. We saw a little bit of this back in 2000 and 1985.
That was 1980s. That was that's right. That was the great peg breaking. Yeah.
But it's never really been close to this. I mean, this chart is, you have to look at the scale here. The kind of the typical is around 160 and higher for the pound, and now we're almost at parity for
I remember when it was 2.
Yeah,
not
exactly.
Not that long ago.
I mean, that's right. I mean, you're talking about just I remember going to Europe in this time and how expensive it was to be in Great Britain because of that exchange rate. So this is really this is unusual. So this is what you're talking about. This is a big change, and it's happening in a relatively short period of time. When we go to the yen, this is what you're talking about. We have seen some move in the yen, and that's actually the yen has moved quite a bit relative to where it's been in the past year. You have to go all the way back to the 90s to see a level this high. So we have seen some currency movement.
Even the 90s and the 80s, yeah.
Exactly. And this is the strength of the US dollar that we're seeing. This is what's happened. And finally the euro, which, as you know, didn't exist before this time period here, really. So they've kind of created it.
That's meaningless. That's meaningless data right there. What's meaningful is after 2000 more smaller.
Yeah. So, but we have been down, under parity here. So not exactly unprecedented for the euro, but this is quite the drop. So, I mean, this is the environment that we're talking about when we're talking about these currencies. And, I think the big difference is, like you said, how much is denominated in dollars, and there's constantly the search for another currency that things could be denominated in, like oil. And other, gold and other currencies or other commodities rather, but dollar's still the big player on the street. And so that this spike in the dollar, is going to hurt more and more as we move forward.
Well, here's my hypothesis for you that the most meaningful of these is Europe itself, and not because of the trade with Europe. I mean, the trade with Europe is not insignificant. You showed me that chart. Maybe you can show it at some point. But the trade with Europe for United States is not insignificant. However, the biggest connection to me, I don't have any chart for that, but believe me, is the financial system. European and American financial system are closely related. Just think of what would happen if Deutsche Bank imploded. You would have carnage all across U.S. financial system because there's so many connections. But Deutsche Bank is not the only bank. You have the SocGen, Societe Generale. You have other European banks, but Deutsche Bank.
And U.S. banks in Europe too. I mean, it's not
US
just
banks in Europe. Exactly. Credit Suisse. But my sense is that if BASF is considering shutting down, this cannot not cause problems in Deutsche Bank. I just don't believe that. And then, so the biggest risk that I would be stress testing right now, I'll show a couple of stress tests at the end, is Europe risk to your portfolios, because I believe that when you see the results, right, you should be trying to minimize Europe exposure, direct or indirect, and that's why you should be doing stress testing. But in terms of trade, Jan, what do you think? I mean, Europe versus Japan, how are those countries trading with the United States?
Let's take a look, because like you said, Daniel, I do have a chart here for that. So if we look at this, and this, I've used this in some of the blog postings that I've done in the past. This is this OEC data, and I happen to think it's a great site. So if you want to get on here and play around with this, it's fantastic. But anyways, this is the U.S. So this is the U.S. exports, right? And so when we look at the different countries around the world, our exports go to, Canada and Mexico primarily as blocks, a little bit to Japan and 5%, which is a pretty sizable amount. But when you look at Europe as a whole, it's this this purple-ish block here. And, that is, somewhere in the 20+%. I didn't add that up beforehand. I think there's actually a way to get this by regions here. But that's a big.
See that, this is about 8, 11, 12. Yeah, it should be close to 20%.
Yeah, it's a large block. It's not quite the size of Asia as a whole, but it's pretty close. So this is a major trading partner. That's where our exports are going. So if you think about it, these exports that we're producing in US dollars are going over to these countries, and it's more expensive for all of these countries because of that currency. Our imports are
but
cheaper.
also, if those countries tank, that's that much less product you can export, and that puts additional pressure on the economy.
Well, and the price of it, if the price gets too expensive, that's going to help cause that tank, right? I mean, you can't.
That's right.
It's
like a double whammy,
yeah. And then so here are imports, which are smaller from these countries, but Japan is one, but we're importing and getting more favorable terms on the import. So on this side, it's a benefit to the U.S., but on the export side, it's probably more painful because it's more expensive, and they're not going to be able to. It's not like the price elasticity for anything other than actually for pretty much anything other than food. You can't just keep on increasing the price and expecting the same amount to flow.
Yeah.
So, and so when you look at like the UK in particular, the exports, petroleum, gold, like the kinds of things that we export to them. Again, I'm not going to get into looking at each one of these individually, but these are things that don't tend to be, again, gold is priced in US dollars, so that's going to be, in terms of an investment. But when in the event that you need that for any sort of goods, those goods are not necessarily elastic. Petroleum and things like that. So anyways, this is a great thing to click around. But the point is really that we are going to probably see our exports to Europe have to be curtailed or reduced just because of the cost of them. Our imports can, probably increase, but again, it's not a zero-sum game, I don't think.
Yeah, and I think that quite frankly, today we're living in such a crazy financial economy that it has very little connection to real world anymore. And to me, when you think of Europe, UK, and Japan, what should you worry about? I would think about this question: what banks can you name from those countries?
Mm-hmm.
All right. So from Japan, almost anybody will name Deutsche Bank. But that's, and then you take Europe as a whole, right? There's BNP Paribas, Societe Generale, Credit Suisse. What else? Are there other European financial institutions you can think of? ING,
yeah.
What else?
Yeah, I mean, I think basically what you can do is look through your portfolio and just look at that financial sector. If you have the ability to go through and look at the financial sector and just see where the European banks, where the Japanese banks, what are the
okay, can you name a Japanese bank? You've been in this business for a long time. Let's see. I guarantee we can do some numbers, and we'll do some numbers, but this is a stress test right here. If you cannot name a Japanese bank, then it probably will not be relevant for portfolios of financial advisors. Can you name one?
Isn't Nomura? There's a Mizuho.
I was going to say that, yeah. But those are not big it because you worked with hedge funds and all this stuff, and they have hedge fund arms in the States, and I don't think like most people will know that these banks even exist.
No, but Nomura does have a presence in the U.S. at least, and I think that the other ones do. But you're right. I mean, it's
Right.
you know these Japanese banks are not as present in your lives as the European banks.
What about UK banks? What about UK banks?
Well, there's ING.
I thought that was Dutch. No,
No, I don't think is it.
I always thought ING was Dutch. Maybe I'm wrong.
Maybe you're right. I can't tell. Oh no, you're right. ING is Dutch.
Bearings. They bought Bearings, and Bearings.
They bought Bearings. Bearings was the big one, right?
Yeah, that was a British bank, right? So Bearings.
Yeah, let me look one up here. Abbey, ABC. Let's see. Standard Charter. That's one I know. Royal Bank of Scotland. RBS. Barclays. That's a big one. Santander, UK. HSBC.
Yeah,
HSBC.
Santander is a UK bank, right? Huh. Right, but I didn't know that. But yeah,
I think it's a Spanish bank actually. I think there's just a UK division of it. So Schroders. Anyways, yeah, if you have UK banks in your portfolio, if you have, this is something that you should.
But Bearings is a big player. I mean, ING and Bearings, those are big players. Plus, I'm sure that the US banks have a big presence in the UK.
But that's what I was going to say. I think it's less important about where they're located as to where they do business. Where they're domiciled, because where their business comes from is really one of the important.
Yeah, it's true. But with Japan, my point was really the Japan that it's fairly isolated. You can. It's very hard to find any diversification these days, but Japan is somewhat isolated because you could see that when Fed started raising rates, Japan still didn't raise rates. It's unfathomable to me how they can continue to do that. And they're suffering with the yen, but they should be suffering much more. Their debt to GDP is insane, just off the charts. It's like this, modern monetary theory poster child. So, but because Japan is more self-contained, yeah, it does a lot of business, but I'm talking about finance flows, right? What's happening with Europe should be absolutely the top question for US-based portfolio, and what's happening in US too. But Europe is really this is it seems like if the industrial might of Germany is shut down, then I don't know what else there is left in Europe, because Europe used to have a lot of things, but lately it's been seemingly mostly like you have the German industrial might shut down, you have the Dutch farming, right? When we saw those protests, when these brave farmers with tractors would come out and pour manure on government buildings, that was awesome. So the question becomes like, what else is there left in Europe? And it seems to me that that the situation is very dire for Europe, and for your portfolios, you should really think about where you have that exposure to Europe, direct or indirect, because exposure to, say, Deutsche Bank in the US is exposure to Europe.
Just to get back to that point about debt to GDP being insane, while you were talking, I used this little Google thing that we have on our desktops. Japan is 240%, ratio of debt to GDP, 240. To give context of size, the U.S. is fourth on this list from the World Economics Research in London at 123, almost 124, 124% debt to GDP. And for further context, the UK, 86%, so less than 100%. And Germany is 63%.
That high? I thought Germany would be like 5.
I think in this day and age,
like that. I think they were forced to do that.
I think in this day and age, 60% is really low. Although Russia on here is 12. So,
it's a different kind of it's a different kind of economy, you might say.
Well, the only
for Germany, yeah.
The only countries down here close to parity are things like Hong Kong, which is really part of China, Taiwan at 20%, but there's nothing that's really that low. Even so Germany.
Yeah, but 240%. I read books about this. I mean, they literally build bridges to nowhere in Japan just to spend money. This is how much they love the idea of like monetary economics, that, you know, this is not really Keynes. They call it Keynesian, but I read Keynes. He didn't go nearly that far.
Well, they're trying the helicopter. They're trying the Bernanke's helicopter, I guess.
That's right. They were the helicopter before the helicopter. You know, Let me jump to close it out. Let's look at a couple of stress tests. As you know, portfolio crash testing is an application that we built for financial advisors that allows you to stress test portfolios of your clients. And for these times, it would be very helpful if you had it. Again, you can watch the show without it, but we're going to do some exercises in this app because it allows us to quantify the results for any portfolio. So I have this risk moderate portfolio, which is, you know, essentially kind of like 60-40. And I'm going to go through these different currency. We're going to try to do standard deviation shock. So you see the volatility is 9.4. That is annualized standard deviation, Jan, right? That's to give you guidance how much to shock. And you can do these neat custom stress tests here that we've built. So I'm going to do, why don't I do minus 28? That's a 3 standard deviation move on the pound. So that could drop a lot. What would happen in this portfolio? Remember, this is supposed to be a moderate portfolio with quite a lot of bonds and protection and diversification. Yet it drops about 20% in this case. The dollars and percent are the same because it's a 100 some portfolio. So what this is telling us is roughly the beta of a moderate portfolio, like a 60-40 that you would put your clients that are not that far from retirement. Its beta is about 2/3, right? About. So you have 20% loss on a 28% drop in the pound. So pound turns out to have a very serious impact on US based portfolio. Essentially, there is some global stuff here, right? There is some global stuff, but not a lot.
We have some global ones,
but not a lot. Not a lot. It's mostly a US based portfolio. Yet it has a dramatic impact. So the pound, right? And look, you know, we have drops. Obviously, S&P 500 drops, but even the balanced Invesco balanced is contributing 4% to our loss. Yeah. I mean, it's 17% of our portfolio, but this is serious stuff. Like everything loses. The only thing that goes up is the PIMCO short-term return fund. In this scenario, it gives us a little bit of a cushion, but barely any. Right?
Barely anything. Barely. Actually, I mean, it's pretty much. I mean, it shows zero. So it just.
So, it's rounded to zero basically. Let's try the yen. What happens if the yen drops? I'm going to do a 3%, 3 standard deviation shock. Notice that it's actually quite inconclusive. So our model agrees with the logic that the Japan is not so closely tied to the US, and the overall loss is about 2.3%, which is what you want a moderate portfolio to protect you. But remember, not from Europe. Sorry,
this is actually a gain, a total scenario gain. Those are the losses.
No, it's a minus. It says minus here. I see.
Well, but that's just the losses. The total scenario is 5.
Oh, sorry. Oh, you know what? That's right. I was looking at the wrong place. I need some more training. It's 5.6% gain. That's right. 5.6% gain for this scenario.
Yep.
So now let's look at the euro. Let's do a minus 24 shock and see what happens. So there's a big loss. 13% is a very sizable loss for this portfolio because it's a moderate portfolio. So notice we're not touching anything in the US per se. We're only moving euro down. And yet we're experiencing 13% loss. With pound, the loss was even higher.
Yep.
So you have what you can conclude here is that your portfolios, you all watching, your portfolios are heavily exposed to euro and pound, even if you don't hold any of these investments. Even if
I mean, it's just the nature of the global nature of these portfolios. You know, the global nature of everything in the S&P 500 and the intertwined nature of global markets. You know, so you
like
can't
not Japan.
Well, I mean, Japan had, Japan was a little bit different. Yeah, Japan was, what was more, and I think that makes sense though. I mean, but the European markets for sure, and we saw that kind of when we looked a couple episodes ago. If you remember when we looked at the correlations of equity markets, the high correlation of the European markets with the US and a much lower correlation with the Japanese markets that is rising in this latest year. But typically, Japan's a good diversifier. And so, and then the currency seems to be bearing that out a little bit, at least with the historic correlations that we see here.
Yeah, they're in trouble, but at least they're going to be in trouble in their own unique, special way.
Well, you wonder about that though, Daniel. I mean, because this is showing about how it works historically, but I'm wondering if those if that kind of isolation of Japan will continue. But like you pointed out, we don't have a huge trade with them. I don't know. This is currencies and things like that are not where I'm most comfortable. But I think this is really good.
There are a lot of hedge funds that do various carry trades with yen. I don't know how prevalent it is today, but like they will borrow yen because it's 0%.
Yeah.
And now that is like, remember when long-term capital management imploded in 1998, I think somebody coined the phrase picking up nickels in front of a steamroller.
Right. Yeah.
There's a lot of trades like that now. So my point is, with this stress test, first of all, you should be conscious of these effects. They're not separate, right? We know that U.S. markets are crashing too, right? We didn't talk about it today because we talk about it every show. We talked about the potential for a major drop, but U.S. markets could be stabilized if only like Powell utters a word or two. But but he cannot create gas for Europe. I'm sorry.
Right.
There's not enough gas in Jerome Powell to heat Europe this winter. And so I'm kind of laughing because it's not a light situation. We're very sorry for all the suffering, but you know what? You can't cry all the time. Sometimes you just have to, you have to relax and joke a little bit. So the bottom line is you should stress test your portfolios. You should prepare your clients. You should think about what contributors there are that will contribute to risk in these scenarios. And you can also, don't forget to subscribe, please, to the show if you like it. And if you're interested in portfolio crash testing software for your clients, you can request a demo below the video. I'm sure there'll be a link somewhere. Any closing thoughts, Jan?
The only thing I wanted to point out was on that stress test, just because you had a 0 there does not mean that the pound and the yen aren't moving in those scenarios. They are moving. A 0 in that environment doesn't actually mean that we're not moving. So when you see those reactions that we do in these any of these stress tests, it means that every other factor in the world is moving according to what we did in that stress test.
The 0 just means I did not touch it. I did not stress it.
Exactly. Yeah, if you really want to show what a 0 would be, you'd have to put like something like 0.0001, or like something like very, very small to say like, no, we're actually anchoring this at 0. We're not ignoring it. So anyways, that's all I wanted to point out in that we're not saying that the euro can move down 3 standard deviations while the pound and the yen stay exactly at 0. That's not the case at all.
That's right.
But no, I think that's it. This is, as I said earlier, Daniel, I don't consider myself a currency expert by any stretch of the imagination, but I think that if you're looking at your portfolios, understanding the impact of currency on your portfolio when you're seeing these kinds of moves is a very helpful thing. Like being able to understand what a British pound crash can mean for your client's portfolio potentially. Again, sometimes when events happen in these isolated area or because of a certain event, if an event happens because of, if there's a specific cause, it doesn't necessarily mean that the rest of the world is going to react the way that it has in the past, but it's very important to understand what is expected at the very least.
Well, plus our models are also predictive to a large degree. The way we run models in RiXtrema, they're not purely based on recent past. Right. They actually weigh tail periods. So it's a special kind of algorithm, but you know what? You don't need to be a steamroller mechanic to understand what will happen if you try to pick up a nickel from under it, So that's like, you don't have to be a currency expert necessarily. And please,
no, absolutely.
Comment and tell us what you would like to hear about. Maybe there are some topics that you would like to hear about, or maybe you disagree with us or agree. Please comment under the video. Next week, I'm going to be at a big blockchain conference in Dubai, if world doesn't end, which used to be a laughable addition, but now it's actually quite serious. And maybe we'll talk about crypto next week, Jan. Since I'm going to be at that conference, I think that it'd be a very interesting topic because notice that what's happening, Bitcoin is showing signs of resilience. It's actually increased in the last couple of days. And there's somewhere an idea that Bitcoin is a diversifier to the traditional financial system that may be alive. And I think it might be alive partly because Bitcoin was hammered before that. It washed out a lot of the speculation. And the people who stayed in it are people that are outside of the financial system to some degree. And also, I think a lot of people around the world worry about the central bank digital currencies. I worry about them too. I believe they're going to be extremely bad for humanity, for the economy. And people are worried about the banking system. So they're pulling some money out and trying to put it in crypto. And this very interesting trend, I've heard from people in the know that banks are trying to stall on transfers to buy crypto. Like you try to transfer money to buy to a crypto exchange, they're inventing all these new stopgaps, like you have to come into the branch because it's highly risky. You come into the branch, you sign it, and then they call you again. Well, I'm the branch manager. We're worried. Are you under duress? You're like, stop it. You know, if I bought like $200,000 of Tesla, you wouldn't ask me that, even though it's it's a kind of an insane investment. Well, maybe it's not an insane investment. I'm just making an example of volatile investment, right? I shouldn't say that. Maybe it is a good investment, but the point is, there's something going on. There's some dynamic between the legacy banking system and the crypto that's in play, and we can explore that next week. But please comment and tell us what you would like to hear about.
All right, sounds good. And safe travels to Dubai.
Take care, everybody.
Bye.
Talk soon.
Bye.